You know that feeling that building wealth is like some secret club with a language you're never taught? Well, today, we're not just giving you a membership card, we're handing you the actual blueprint. We're going to walk through step by step how you can become the architect of your very own financial future. So let's get building.
But hang on. Before we even think about laying a single brick, let's picture the finished building. I mean, what does financial freedom actually look like to you? Is it leaving a job you don't love? Is it traveling the world without checking your bank account? Or maybe it's just that deep, unshakable peace of mind. Seriously, get that picture clear in your head. That's your why. That's what's going to drive this whole project.
So here's our game plan for today. We'll start with your financial blueprint. Then we'll cover laying the foundation, choosing your materials, designing for strength, and finally, building for the long term. It's a clear path from start to finish. All right, let's dive into section 1, your financial blueprint. This is where you put on your architect's hat. Remember, the goal isn't just to pile up a bunch of money, it's to intentionally design a life that gives you real freedom and security. You know, there's a huge mindset shift we have to make here. It's about moving away from that get-rich-quick slot machine mentality, hoping for one lucky break. Instead, we're focused on the slow, steady, strategic process of laying one brick at a time to build something that will actually last. This isn't about luck, it's about architecture. So, with our blueprint in mind, it's time for section 2, laying the foundation. I mean, you wouldn't build a skyscraper on sand, right? And you definitely can't build lasting wealth on shaky financial ground. Every great structure needs a solid, stable base. Okay, so before you even think about buying a single stock, there are 2 jobs you have to do first. They're absolutely non-negotiable. First, build an emergency fund. We're talking 3 to 6 months of your basic living expenses sitting in a savings account. This is your financial shock absorber. It means a surprise car repair won't force you to sell your investments at the worst possible time. Second, you have to attack high-interest debt. Things like credit cards are like an anchor dragging you down. The interest you're paying on that debt is almost always going to be higher than the gains you're making from investing. It's like trying to fill a bucket that's got a giant hole in it. You gotta plug the hole first. All right, the foundation is poured. Now we get to the really exciting part. Section 3, choosing your materials. These are the assets, the stocks, the funds, the things that will actually form the walls and the roof of your financial house. So first up, we've got stocks. Put simply, when you buy a stock, you're buying a tiny, tiny piece of a company. You become a part owner. And if that company does really well, you have a high potential for growth. But, and it's a big but, with that potential comes higher risk. If the company struggles, well, the value of your little piece can go down too. Next up, we have index funds. Now think of it this way. Instead of trying to find that one winning company, an index fund is like buying a pre-made basket that already contains hundreds, sometimes thousands, of the top companies all at once. It's an incredibly simple way to own a tiny piece of the entire market and get diversified instantly. So what's the real difference here? Well, it's kind of like a horse race. Investing in a single stock is like putting all your money on one horse to win the entire race. High risk, sure, but a potentially huge reward. Investing in an index fund, on the other hand, is like betting that all the top horses combined will have a good day. You're betting on the strength of the entire field, which is a much more reliable long-term way to go. Of course, stocks and funds aren't the only tools in the toolbox. You also have things like REITs, that's real estate investment trusts, which let you invest in a whole portfolio of properties without having to be a landlord. Then there's gold, that classic safe haven asset people flock to when the economy gets a little shaky. And of course, you've got cryptocurrency, a very new, very modern, and highly volatile digital asset. These can add more layers to your plan, but each one definitely comes with its own set of unique risks. Okay, so we've got our materials, but how do we put them all together so our building doesn't collapse during the first market storm? Well, that brings us to section 4, designing for strength. And the key architectural principle here is diversification. You've heard this a million times, right? Don't put all your eggs in one basket. And there's a reason it's the oldest rule in the book. Diversification just means spreading your money across different types of assets to lower your overall risk. The idea is that if one part of your portfolio is having a bad month, another part might be having a great one, creating balance and stability over the long run. So what could this actually look like in practice? Well, imagine a portfolio where the biggest piece, the foundation, say 60%, is made up of those broad index funds. From there, you might add a smaller 20% slice of individual stocks for some extra growth potential. And then you could sprinkle in some other materials, like 10% in REITs, maybe 5% in gold, and a very small, very speculative 5% in crypto. See how each material plays a different role, but together they create a much stronger structure? And that brings me to a quote that you really should write down. Let's just pause on this for a second. The key to successful investing is not timing the market, but time in the market. It's so powerful. Trying to guess when the market's going to go up or down is a losing game for pretty much everyone. The real magic, the real power, comes from simply being invested for a long, long time and letting your wealth grow and compound on its own. Which is the perfect lead-in to our final section, number 5, building for the long term. Because once your design is done, the real work begins. And the most powerful tool you have as both the architect and the builder is just plain old consistency. And listen, this right here might be the most empowering part of this whole thing. You do not need a fortune to get started. Your greatest asset isn't a huge pile of cash. It's time. By making small, regular contributions month after month, you ignite the incredible power of compounding. That's where your returns start earning their own returns. It's this slow, steady, relentless process of laying one brick after another that eventually builds a fortress. So there you have it. That's the blueprint. It isn't some secret code, it's a construction plan. We've walked through how to design your vision, how to lay that solid foundation, and how to choose the right materials. The plan is now officially in your hands. So the only question left is the one you see right here. What is the very first brick that you are going to lay? Is it opening that emergency savings account? Is it paying down that credit card? Or is it making that first small investment? The architect is you, and the time to build is now.